Roth conversions. Everyone is doing them, but should they be? I recently did a video that goes over the number one mistake people make when doing a Roth conversion, so I wanted to make a video that explains when it makes sense to do so. We're going to talk about the different times to do one. We'll touch on tax implications, how you should consider investing Roth IRA dollars inside of your portfolio, and then tie in a case study at the very end to show the value someone can gain from doing a conversion successfully. The important thing here is that this is not a one-size-fits-all strategy. Different people will have different results. Before we kick things off here, if you're new, my name's Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart financial decisions. A Roth conversion is when you move a traditional IRA or 401k into a Roth IRA. You're accelerating the payment of taxes by doing it at a lower tax bracket than what you would if you were to wait until later on in life. You can do this now and enjoy tax-free growth and withdrawals later on. There are many scenarios in which it makes sense to make a Roth conversion. I'm going to talk about 5 times where it makes a lot of sense to do this. So the first one is in low income tax years when you're in a lower income tax bracket. So this might work for people who have temporary dips in income. So you convert when your tax rate is low in these instances to reduce the conversion taxes. So some common scenarios where you might see this is between jobs or after a layoff, early retirement before you start Social Security, when you're starting a business with low initial income, or taking a sabbatical or extended leave from work. So the strategy here is to convert just enough to stay in a lower tax bracket, say the 12% or 22% tax bracket. The next area where this might make sense is in early retirement. So specifically before you're taking required minimum distributions or Social Security. So this is best for retirees in their late 50s and early 60s before required minimum distributions start at age 73. So the reason we do this is reduce future required minimum distributions because as someone grows older, those distributions tend to get larger, which could bump you up into higher tax brackets later on in retirement. So some common scenarios where you're going to see this work is people who are retired but not yet collecting Social Security. This is often a good time to start doing these types of conversions. You're no longer earning a salary and you're keeping taxable income low. So the strategy here is similar to the strategy in step number 1 is you want to convert up to the limit of a low tax bracket, say the 22 or the 24% tax bracket, before Social Security kicks in and before required minimum distributions kick in, which could ultimately tip you over into a higher tax bracket. So the third step we're going to talk about is people who might be moving to a high income tax state. So this is best for people who are moving from a low income tax state or a no income tax state like Florida or Texas and moving to a higher income tax state like a state like California or New York. So this will help you to avoid state income tax on your conversions if your current state has no income tax or a low income tax. Step number 4, we want to think about this strategically by doing annual conversions. This is called tax bracket filling. So this is best for anyone optimizing tax brackets. You want to convert just enough each year to stay in lower tax bracket. So common scenarios you want to consider when you're doing this is staying below the 22 or the 24% tax bracket, depending on the amount of money you have in a traditional IRA and where your other income sources are. And you also want to be cognizant of Medicare IRMA surcharges. That's just a higher premium for higher income retirees. So if you convert too much, you might tip yourself into a higher IRMA bracket. And if you tip yourself into a higher IRMA bracket, you can end up paying an extra $1,000 or $2,000 a year for Medicare premiums. Just something to be aware of when you're doing this tax bracket filling strategy. The fifth and final step you want to be aware of is when you're making non-deductible traditional IRA contributions and you're not subject to the pro rata rule. If you're making contributions to a traditional IRA and are above the income thresholds for deductibility, you should immediately convert those contributions to Roth dollars so they can grow tax-free and be distributed tax-free in retirement. There's going to be no tax implications up front for doing this, assuming you're not affected by the pro rata rule. And if you don't know what the pro rata rule is or you've never heard of it, you go back and watch my video that I made earlier this week on the number 1 Roth conversion mistake people make. It'll go over the pro rata rule in depth and tell you ways to avoid it, so that way it's not something that ultimately affects your financial plan. While Roths are a great tool, they don't always make sense for everyone. Let's go over some examples of when it might not be okay to utilize the Roth IRA. So high earners who can't contribute directly because of income limits, those above the Roth IRA income limits for 2025, which is $161,000 for someone filing singly and $240,000 for someone filing married, they can't directly contribute to the Roth IRA. So they're going to be subject to a penalty if they do choose to go ahead and contribute directly to a Roth IRA. So the alternative here is to use a backdoor Roth IRA by converting a traditional IRA where you're making that non-deductible contribution and then immediately converting it to Roth dollars, there's no tax implications and it gets around that contribution limit rule. So you want to check the income limits before trying to contribute directly. If you find that your adjusted gross income is above those limits, you do not want to make a direct Roth IRA contribution. The second person or the second example that you might not want to consider using a Roth IRA are people who are expecting to be in a much lower tax bracket in retirement. So this is best for those people who are in peak earning years and who expect lower income later on, specifically during retirement. Roth IRA contributions are taxed up front, which may not be ideal if you'll have lower taxes in retirement. A better alternative here is to contribute to a traditional IRA and get upfront tax deductions for tax savings now. Later on, you can reassess whether doing a Roth conversion makes the most sense for you, but if it still looks like you're going to be in a lower income tax bracket in retirement, oftentimes it makes sense just to leave it as a traditional IRA contribution. So if you're in a high tax bracket today, say 32% or more, a traditional IRA is often the better alternative here. And then the third person who might not want to utilize a Roth IRA is somebody who has short-term needs or has some liquidity problems. So this is best for anyone who may need the money before 59 and a half. Why? Because Roth IRAs are meant for long-term growth. And while contributions can be withdrawn anytime after certain criteria are met, investment earnings may be subject to penalties. So a better alternative here would be utilizing a taxable brokerage account where there's no penalties or withdrawal rules, or even a high-yield savings accounts for very short-term liquidity needs because we don't want to subject you to market risk. So anybody who needs the money within less than 5 years, typically a Roth IRA is not going to make sense for you. Now, before we dive into a brief case study, I want to talk a little bit about maximizing asset location. Brokerage accounts, cash, traditional retirement accounts, and Roth retirement accounts are a few of the types of accounts you're likely to have in your overall portfolio. When you have a Roth account, whether it's a 401k or an IRA, making this the most aggressive portion of your portfolio often makes the most sense. This does not mean investing only in risky securities. It means that for someone who overall their portfolio is made up of 70% stock and 30% bonds, most of their stock positions should be in the Roth IRA account. But why? Since Roth IRAs offer tax-free growth and withdrawals, it's best to hold investments that grow the most over time. Roths are also usually the last bucket of money you should touch in your portfolio, so they have the most time to grow and bounce back from market volatility. There are times to take less risk in Roths, such as when it's the only source of funds you have, but for the most part, opting to be a bit more aggressive will pay off in the long run. This is simply maximizing your asset location to have a better payoff in the long run. Okay, so now that we've covered the basics, I want to do a brief case study. This case study is going to cover two different individuals. They're both 65 years old. They're both retired. One earns a higher income level than the other and is in a higher tax bracket, where the other one is in a lower or more moderate income tax bracket. So the things that we need to be cognizant of when doing a Roth conversion for those in retirement, specifically those who are paying into Medicare, is we want to not just look at that from a tax lens, but we also want to understand how it's going to affect their Medicare premiums, specifically Medicare Part B and Part D and the IRMAA surcharges that they will receive if they were to go over certain income thresholds. So let's dive into the example here. Okay, so starting with the higher income individual, this individual makes $490,000 in adjusted gross income before they're considering doing the Roth conversion. Adding an extra $30,000 in income for the Roth conversion will put this person in the 35% income tax bracket. So it goes to reason that they will pay $10,500 in federal taxes on that Roth conversion amount only. So we're not looking at the total $520,000, just the incremental change in taxes by converting that extra $30,000. So they will pay an extra $10,500 in federal taxes over what they would have had they not done the conversion. The Medicare premiums for Part B would have jumped $420 for the year, and Medicare Part D would have jumped another $82. So essentially, this person paid an extra $11,000 between taxes and Medicare premiums, meaning that this money was taxed at an effective 36% rate when we're going through and adding in all of the different surcharges and the federal taxes paid. So let's compare this to somebody now who's in a lower income tax bracket. So in this instance, we're going to talk about somebody who makes $70,000 in adjusted gross income. This person wants to do the same $30,000 Roth conversion, so their total adjusted gross income would be $100,000. That would put them squarely in the 22% tax bracket. So by converting that extra $30,000, you're going to pay an extra $6,600 in federal taxes. Now, there would be no Medicare Part B or Part D premiums on top of this because they're still going to be below the threshold before the surcharges would apply. So this individual was able to essentially pay only the 22% tax on this conversion. So while it did cost them an extra $6,600, you'll see they're about $5,000 better off than that individual who's at the higher tax bracket. And this is what we mean when we say that it makes sense for people in lower tax brackets to utilize Roth conversions over those who are in higher tax brackets, because you're spreading out the tax burden across the lower percentage threshold. Going through the math, if this person were to convert another $20,000 or $25,000, they would begin approaching the same taxes and Medicare premium amount that the person at the higher income level had to pay in the previous example, but they would have done nearly double the amount of Roth conversion. This is why it makes sense when you're in a lower tax bracket to do the Roth conversions as opposed to the higher tax bracket. So now that we covered the example of, a higher income individual versus a lower income individual, I hope you're starting to see the nuanced nature of doing Roth conversions. It's not a one size fits all approach, and you want to take into consideration future required minimum distributions you're going to receive as well, where it might actually be more effective for somebody in the higher income tax bracket to convert the Roth money ahead of time, so that way they don't ultimately dip into the 37% bracket once they start taking the required minimum distributions at age 73. These are all things that you need to reason through with your financial advisor. So while that was a good illustrative purpose, it was rather simplistic in the sense that it doesn't encompass everything you need to be thinking of when it comes to a Roth conversion in retirement. Okay, now you know just about everything you need to consider when reasoning through a Roth conversion and how to utilize a Roth IRA as a portion of your portfolio. I really hope that you enjoyed this video, and I have much more helpful content planned for you. So you don't miss it, please give this video a thumbs up and subscribe below so that we can stay in touch. I'd hate for you to miss some of this helpful content. And if you're still struggling with how to incorporate this strategy in your financial plan, please feel free to schedule time on my calendar in the link below. Thank you so much for watching.